Welcome to TheoTrade. It's August 6, 2016. You are watching the Theo Video Weekend Update. I start on this weekend with a broader look at the spiders, specifically the S&P 500. It's a 5-year weekly. Why such a broad view? Well, it's fairly awe-inspiring to see the fact that the spiders over the last 5 years have gone from 107 to 218. We close the week out, and that's this previous week. We close out the week on nothing less than momentum to the upside, and substantial momentum to the upside. Again, looking back from just the British exit to right now, and if you want to look from the lows of the British exit to right now, we're trading 198 in the spiders, okay, to roughly 218. Now, if you're not so comfortable with the spiders, okay, we can represent that, of course, by looking specifically at the SPX. Again, similar time frame in the SPX, we actually trade down to, well, just under, 2,000 to roughly 2182. Again, statistically speaking, it is so far outside of the norm over here. We're looking about 4 deviations in terms of the move from roughly June 27th till right now. Now, all statistics aside over here, one of the things that you have to think about, number one as a trader and number two as an investor, and I will separate those out. The trader in me looks at just the shortest term statistics over here, like, wow, I mean, come on, this kind of a move in the SPX, and just to kind of point this out, this kind of a move that is almost 200 points, and it's almost 200 points down to the button over here, that kind of a move, if you go over to thinkorswim's trade tab and you look at something called expected move, and it's something we talk about all the time over here, but how long does it typically take for something like a 200-point move to occur? And this is where you're all the way out here in what, 150-day kind of time window before you start seeing expected moves exceeding or in and around 200 points. Now, granted, the volatility was a little bit higher back in late June during the British exit over there, but you have to realize when I talk about, like, okay, it's 4 deviations outside of the norm over there, it doesn't matter, market still goes. But to put this into perspective, in a 1-month period of time, and now we are looking just about a month, okay, take a look at about what a normal month could be. So right in here, the 27 or 34-day expirations, your average month, what does it have? $50, $54 kind of move expected in there, maybe $60. Again, and that's where I come up with, in a brief moment, a $50 move, let's say, is 1 standard deviation. So you get like a $200 move, and sure, you're looking at like 3-4 standard deviations. So it's, what traders would kind of call, it's a once-in-a-lifetime move. And one of the craziest things about it is it happened to the upside. So again, I divert back over to the chart. The trader in me looks at the statistical move, looks at it and says, yeah, you can't, be long this type of a move. Now, granted, I've shorted a handful of times up over here, and I've been run over, and that's all right. But statistically speaking, I can't be long, right, after a 4 deviation move on one side of the market without ever really looking back. And we had the threat of a down move one day, and we have this explosive move. Granted, hey, it's a jobs report on Friday, but that's neither here nor there. So the trader in me right now, again, you want to short. In the short term, you want to be short. But then I got to bring up the investor. Why? Because it matters. Because right now, wherever you want to look in the marketplace, the search for alpha is on. That basically means you're trying to squeeze some juice out of anything you possibly can. In this business, as an investor, as a trader, it doesn't matter. You got to squeeze some juice out there. And where do you go? Right now, if you're long the S&P, now that means, listen, you got to think about this again as an investor. You got a 401k, Do you? Possibly. I can't answer for that for you. You've got to answer that. You have an IRA. You have capital invested in the market. And you have to realize, in perspective here, over the last 5 years, how far we've really come. Then block all the garbage in the media out. Okay? Yeah, I heard Carl Icahn. He's short. So is everybody else. And we're still getting run over. But there's a reason for it. And it comes down to the simplistic idea of risk-reward. And you have to believe as an investor. Forget about short-term traders. Okay? And I'm talking short-term traders, all right, positions that you're going to hold for a month, for 2 months, for 3 months, maybe a position for a week. Again, forget about those for a second. What I'm concerned about, and what I've been talking to a lot of the other Theo traders about, is this idea like, wait, we're forgetting about our clientele's investments. And it doesn't matter where you want to look. You want to look at the SPX? I'd say that that's an overcooked turkey, right? And over the next year or two, how could you want to be long a marketplace that in the last 5 years has had a little bit too much appreciation? Now, again, I think you could probably make arguments. The Bank of Japan shall save the world. Janet Yellen will come out of the cave, right? By the way, yes, she lives in a cave now. I don't know why. Or you can talk about the ECB and Mario Draghi, which very often we call Ivan Drago. You got to poke fun at the central bankers because there's nothing left over there, fueling markets to the upside. But it doesn't matter where you want to seek any types of returns. You want to go look at the NASDAQ. You want to start looking at individual stocks. You tell me, okay, where there's going to be yield out there. Maybe we should go over to gold because gold is one of the most talked about products. But I think you do have to be a little bit concerned given the fact that, hey, maybe gold could explode to the upside. But right now, year to date, it has gone, and I'm looking at GLD, it has gone from, 100 to 127. These are phenomenal returns in a short period of time that you have to start to weigh like, there's the last 6 months has even been phenomenal over there. But you really have to start to weigh your options right now. This is a dangerous product even to buy because if the market doesn't turn around and tank, and I'm talking if the S&P 500 doesn't turn around and tank, you're going to get crushed in gold. Gold will have an impact from the dollar over here. But again, it doesn't matter. You want to go look at stocks like Google. You can go fish at any product that you want to go after. What's easier right now? To try to fish for stocks that could possibly go up or to take the short side of the market? From where I stand as an investor, I have to be short right now. The risk to the downside, being long in the markets, the risk to the downside far outweighs any upside potential. And again, we can all make relevant arguments for the markets continuing to appreciate to the upside. But that it doesn't make a difference. Even if the markets do continue to appreciate to the upside, there's still not enough juice to the upside left to warrant me holding long positions out there. And then I think, and I look down the list of the usual suspects, whether it's Facebook, whether it's Apple, okay, no matter where you look, again, the yield is just not there. Okay, where are you going to go? You're going to go into bonds? The bonds, I think they're kind of full right now. Right? And that's where, I started bringing up product after product after product. And I understand exactly what the market, and fund managers face right now. Again, it's the scramble to find any kind of juice whatsoever. One of the things I think you need to consider is even when you look at a product like the spiders, and I'll start back to the spiders over here, you look at a product like the spiders and you realize, you know what? I'm going to own the spiders, or I'm going to own Apple. And I'm going to go out there, for instance, and I'm going to sell covered calls. You got to realize the prices on the calls, okay? These calls right now, look at the price of the calls, okay, versus the equidistant puts. All I'm just looking at here is the 220 calls, right? Where are the 220 calls? 220 calls trading right at about 60 cents. Look at the 216 puts. Okay, this is only a 13-day option over here. The puts are trading for a huge premium over the calls. And just to quantify, the stock is actually leaning towards the 220 calls, meaning the 220 calls, hey, they should be trading a little bit more. They're not. The puts are trading for more. What does that mean to me? It means right now you want to squeeze a little bit of juice out of this market. You'd be short the spiders and sell the puts. Why? Because the skew favors right now those that are short. You can go further out in time. You even want to sell options, some 41 days out. You call it, okay? You call it. Look at the out-of-the-money calls. Things aren't even trading for 50 cents. Look at the equidistant puts, okay? What, $1.76? $1.77? Again, in every way, shape, or form, it's worthwhile to seriously consider at this point as an investor to be short. Now, how to specifically do that, okay, is something, again, we talk about every single day at TheoTrade. Like, you've got to step up to the plate and understand, don't go out. Do not go out and start investing in inverse and double inverse products, something like the VXX. I don't know if you guys recognize this. The VXX, this is over the last 5 years, it's gone from $1,000 to $9. It's been in the fastest contango. Volatility's been in the fastest contango ever recorded in history. What does that mean? It means a product like the VXX, it's going to get crushed. Okay? One of the other favorites, UVXY. If you own UVXY, they keep reverse splitting it so that it doesn't go to zero. These products are going straight down. This is a 5-year weekly. All right, let me just bring it up on a 6-month over here, because on a 6-month you can't even believe. In the last 6 months, it's gone from 309 to 21. Okay, these products are horrific. You need to know what products to trade, how to effectively get short, and you can't use the excuse, I'm sorry, I'm in a 401k, I can't do anything in my 401k. You absolutely can do stuff in your 401k, and at the very least, learn how to hedge your risk. And a lot of what we're going to be talking about is for those of you, if you're not ready to give up your bullish positions, at the very least, learn how to mitigate the downside risks. Okay? And forget about the idea of buying puts against your position. It's going to cost you a fortune. You just saw the price of those puts. You got to start thinking about this stuff logically. The markets right now, okay? As I say, this is an overcooked turkey. Are we on borrowed time? Sure. Can we progress higher? Absolutely. And I say that without unequivocation. I'm short markets as an investor. I'm short markets as a trader. Do I think markets can go higher? Absolutely. But I still think that there's dramatically more downside potential to these markets. Thanks everybody for joining us here on the weekend update of TheoTrade. Tune in all this week to TheoTrade Chat. Have a great weekend. Bye-bye.